with the LBMA contract, the spot contracts are primarily unallocated contracts. So there's no dedicated bar for each contract of trading. So I tend to ignore the price signals that we're seeing, and I just focus on bar availability. And the best signal I know for that is the actual lease rate in London. And when there's a lot of metal in the vaults, that the vault holders like to lease it out so that they don't have to hold it and insure it. And that typically drives a negative lease rate, meaning that you have to return less metal than you actually borrow because you take it off their hands for a period. But we've now seen in the last few weeks here, we've seen the silver lease rate spike to a positive and start to move up quite strongly.
Yeah, and that's a very dramatic chart. I was able to see that, and we can post that on the video here as well.
Yeah, now it can go much higher when there's a panic. For me, it's that we've crossed kind of the Rubicon, if you want to put it that way, or the tripwire into metal shortage in London, which is the primary physical market. And it's the one that's being advertised as being so flush with metal. So the signals, they don't match the reality that we know that there's 1,000-ounce bar shortage in the market. Now, to the second part of your question there, in terms of the amount of metal at the COMEX this month, yesterday, being February 24th, was the final trading day for the March futures contract. And the day ended with still about 85 million ounces of silver contracts extant. So what that does is create claims now on the vault stock in New York of the primary, half a dozen or 8 vaults that are there for the COMEX, the CME COMEX. So we know that those vaults hold about 135 million ounces of registered silver ounces. So the registered category is the category that's available for delivery. So we'll have to follow now the deliveries each day and watch how that impacts the spreadsheet that's put out by the COMEX in terms of their vault holdings. Now, to complicate matters, we know that the COMEX rulebook allows forced cash settlement at the option of the directors if they deem it's in the interests of the exchange. So, there will be some things going on there in the market that, we won't fully have visibility of. But the bottom line is that, they can force cash shortage, but at the same time, there is a legitimate physical bar shortage that can't be met with cash. So we'll have to see how that balances out.
So are we seeing this shortage as well? Could we chalk some of the data of the backwardation, so the cost of rolling a contract forward? As Ed Steer recently pointed out, this could be another kind of symptom of that as well, correct?
Well, yeah, backwardation usually reflects the fact that your spot market price is higher than your futures market. And the problem is that if you can't extinguish that backwardation relatively quickly, it's an indicator that there's a real problem and actually that you're losing confidence in the market, because bar holders, if you do have bars that are in the market and available to market, they can get guaranteed return by simply selling spot, buying future, and then getting delivery in the future of the bar to get, not exact bar, but to get bars back to replace that which you have sold. So if you can't sell spot and buy futures and extinguish the backwardation, it's a problem. It's an indication of loss of trust to some extent, and actually losing confidence in fiat dollars ultimately, because the unwillingness to part with the metal that is held in the vaults to get the fiat dollar profit.
So is there any way to tell what inventory levels are in London and New York? And obviously you were saying the spiking lease rates are a reflection of this. So can we actually tell what those inventory levels are?
Well, the best source I know for that information is Ronan Manley there at Bullion Star, and the work he's done is showing in round numbers is about 1 billion ounces these days in the LBMA in London. And that approximately 85% or 850 million ounces are putatively held by the ETFs, exchange traded funds, so like SLV and some of the others. So that would only leave in the order of about 150 million ounces. Now, I know you'll probably lead into this later, but the statement there of Jeff Curry from Goldman that the ETFs are actually selling or shorting into the market. He used the word selling, but shorting into the market metal, which is held for the ETF shareholders, is concerning, but it could create a secondary artificial supply of metal into the market, ultimately, of these rehypothecated bars that they're supposed to be holding. So it's unclear in the net then.
Can you walk us through why his words were so profound in that interview?
Disturbing, right? Because he was quite, I don't know the right word, maybe a little bit cocky about it, but he was saying people think that these ETFs are actually creating shortages, and these people don't understand and don't realize that the ETFs simply turn around, they secure the metal for shareholders, and then turn around and sell it into the market, short it into the market. So what's disturbing about that is that the ETFs are supposed to be holding the bars as segregated bars and vaults, protected for their shareholders, who are the beneficial owners of those bars. And in essence, what he's alleging is that these ETFs are actually creating a second claim on the bars, because you have the owners who have claim on the bars. And if they're hedging them into the market or selling them, as he said, into the market, you're basically creating two claims on one bar, which is the old trick again, right? And that goes back to Blythe Masters of JP Morgan back in 2012, where she was interviewed on CNBC and asked directly if JP Morgan was rigging or affecting the silver price. And she said, no, we don't. We simply hedge for our clients. And we know that JP Morgan, for numerous ETFs, are the custodial vault holders of the metal. And if JP Morgan is indeed shorting this stuff into the market, and what she calls a balanced book being the metal that they hold versus the short that they put on the book for their clients, what they're really doing is that they are shorting something into the market which they would know is owned by others, right? They are the custodians and they operate at the direction of the trustees of the ETFs. In the case of SLV, the trustee is Bank of New York Mellon. And the custodian agreement says that they will do what they're being instructed to do by Bank of New York Mellon. But, to say that we're simply doing what our clients tell us to do, they would have knowledge that this metal is not owned by the ETFs. And that's concerning to hear. So It's exactly what everybody was concerned about, which is basically multiple claims for bars or non-extant bars in the vault and shorted into the market.
And of course, we'll put both of the links to those interviews in the show notes as well.
Yep.
But you recently pointed out that there has been a 354% increase in physical silver deliveries out of China. So could this be to help cover the silver that Jeff has pointed out could be the ETFs shorting into the market?
Yeah, don't know. We don't know those details, but we do know there in Shanghai that there's the futures market is 335 million ounces of silver deliveries. So more research needs to be done into that. But it was a flag that I saw raised yesterday. But we do know that, if there's only 150 million of total ounces available in London, we know there's about 135 million ounces in the registered category in New York, but 85 million of those could putatively have been claimed now through the March contract for delivery. We know that the hundreds of millions of ounces that the ETFs would need to secure in order to cover the shorts wouldn't be available.
So we've seen in the not too distant past some counterfeit bars come from China. So do you see this as a risk of sourcing silver from China at this time, David?
Well, you'd have to do a proper audit and assay process to ensure the security of, what is coming. So I personally wouldn't trust it, but if you have a proper assay protocol in place, you could do your statistical sampling in order to confirm the validity of what you're receiving. So